For the first keynote of the day, we figured it would be a good idea to sort of situate the nature of fintechs in the wider global context. For this purpose with us, we've got Lars Hornhoff, who's a professor of finance at the Technical University of Dresden. He is asking very intriguing questions that I would say many of us have already wondered about in the past. The first one we've already heard being touched upon in the opening remarks. Are fintechs good or bad for traditional finance? What makes a successful fintech? I mean, we've seen some successful stories. We've also seen some big failures over the last couple of years. And then also looking at AI, for example, what impact can ChatGPT have on the industry? But as opposed to most of us wondering these questions during our breakfast or morning shower, Professor Hornhoff is also a globally leading academic, so he has the time and the brain to get the answers for us. So let's welcome him to the stage and see what he has to tell us about the nature of fintech. Thank you very much. Let's welcome him to the stage.
Yeah, thank you very much. I hope I have the brain to answer the question, or actually I wish I would have the brain to answer the questions, but at least I will try my best to give you a good answer. So actually, why did I come up with the question, what works in fintech? Because I thought it's interesting to answer the question, right? And then I thought, well, this is actually a very difficult question to answer, so how should I know what works in fintech? And then I remembered that I wrote a lot of academic papers about it, so I would like to tell you a bit about it. So if you think about what works in fintech, you actually have to make a more structured decision, right? You first have to think about, do you mean what works in fintech in terms of how can you attract fintechs to your jurisdiction? Or do you mean, as we just discussed, right, what works in fintech in terms of what works in order to have these firms survive? Or third, what works for these firms, right? Yesterday night we had a very nice dinner and we discussed actually what can you do to make a fintech successful in the eyes of the customer. And since I know there are a lot of, on the one hand, regulators, but on the other hand, startups, I will actually focus on the last part, right? I mean, that might be most interesting for you guys. So let me start with what works in fintech at the state level. So how can states encourage more fintech startups in their jurisdiction? So Marie-Liz, who invited me here, actually told me that I shouldn't come up with too many statistics and too many regression analyses, so I only give you the most important insights on one slide on this paper. But if you want to see the details, you can actually scan the QR code and just download the entire study. Everything is open access. Okay, so what did we do? So we collected data on around 100 countries and more than 7,000 fintechs all around the world. So this study is very broad, right? It's broadly applicable. It might not be very causal, but actually it tells you a lot about what's going on. Okay, and we got the data from 2005 to 2015, and the first most important insight was the following. Well, we saw that there was a big upsurge in fintech following the financial crisis. Again, there's no causality, right? It just tells you that what we found was there were twice as many fintech startup formations in 2011 as compared to 2008. But then in 2014, actually the numbers started to decline again. Okay, so what are the factors that are important for a fintech to come to a country and to get started? And actually, there's not so much new, right? If you look at the most important factors, actually, first of all, we thought about, is it the developing countries that get fintech, or is it actually Kenya coming up with M-Pesa and so on, right? And then we realized, well, it's actually a more developed country, GDP per capita, strength of legal rights, regulation, having enough labor force which is well educated, were all important factors to attract fintechs and have fintech formations in your respective country, on average, right? And then the second thing we realized is that, of course, once you got seed finance, right, all the startups know that if you want to grow, you need venture capital financing. If you don't have that, right, it doesn't work for you. What else? Well, the infrastructure must be in place. You need telephone subscriptions in order to do it, right? Must not necessarily be a smartphone. A telephone might be enough, as we have seen in the case of M-Pesa, for instance. And you also need secure internet servers. And again, so the red color coding doesn't mean that it's not significant or relevant, but actually, if you have a bad access to loans, that's good for fintechs, right? Because they will take up the market, and we are not the only one finding that. Okay, so far, not much new, I would say. So the next thing we ask, well, is fintech actually good or bad for the traditional financial sector, right? That's more interesting, I think. So we thought, if you have more fintechs, would that make banks and traditional financial institutions more efficient, or will they actually become less efficient and leave out the market? Or will they take more risk, for example? So that's what we answered in the next paper. And what we did, again, we had to collect a lot of data. It took years and years to collect all the data. And then we got data on more than 6,000 financial institutions from more than 80 countries. And we tested in empirical analyses what happens if you have 10 more fintechs formed in your respective country in a given year, right? If you have every year 10 more fintechs relative to the average, how would that turn out? And actually, it turned out quite well. It was good for the net interest margin of the banks. It was good for their return on assets, return on equity. It was also good for their annual stock returns. Obviously, these are not percentage points, right? It tells you that it's a percentage change, meaning if you had an annual stock return of 1%, then if you have 10 fintechs more, it would have been 1.6, okay? So not that you're confusing, right? That you're thinking 60% more annual stock returns, that would be great, but fintechs can't help with that. On the other hand, again, this is not bad, right? Actually, even though the color coding is red, it just tells you that there's a negative relationship. What is the negative relationship? Well, you can actually show if there are 10 more fintechs in the economy, this actually decreased stock volatility of the bank, and it also decreased systematic risk exposure in terms of the marginal expected shortfall. Okay, I think that was quite interesting, and to us it was actually surprising that fintechs had this kind of positive effect. Okay, so let's move from the state level to the firm level. Okay, what matters or what makes a fintech successful? And here again, we collect the data on almost 900 German fintechs. Why did we choose Germany? Because we could get hold of the data, and as we will see in the next presentation, it's very difficult actually to get hold of the data because fintechs are not that clearly defined, right? I mean, there are technology providers that provide financial services, and the other way around. Is that really a fintech or not? Is Facebook a fintech? Well, very difficult questions. So we got the data for more than 20 years on almost 900 fintechs, and what we see is like, the background of the founders is decisive, surprise, surprise. But the thing is, it's not really that one background is sufficient. Well, and also not one background for one particular thing. So meaning, if you have a business degree or you had previous entrepreneurial experience, that actually has been shown to be good in obtaining BA, a business angel or venture capital financing. But it didn't help you with firm survival. It also didn't help you with being more innovative. So on the other hand, if you had a STEM background, being an engineer or technology, mathematics, science, then at least you filed more patents. It didn't mean that you actually obtained them, but you tried to be innovative in a certain way, namely by filing more patents. Moreover, if you had early third-party endorsements, meaning good networks, or if you were a subsidiary of a foreign company, that was good for your firm's survival. And finally, we also checked what is if you have made statements on your website which were more B2B related, or you actually positioned yourself as a technology provider. Again, that was positive for your firm's survival. On the other hand, if you positioned yourself more in the traditional banking sector in terms of you did financing, asset management, and you said like you kind of reforming what they are already doing, this was actually bad for your firm's survival and also bad in terms of your innovation capacity. Okay, let's come to what matters for the investors. So the first question we asked was, because it's probably one of the most important questions of our time, right? I mean, do retail investors invest because they have true ESG preferences? Meaning that they have true inherent preferences to do something good for the environment? Or did they just believe it's more profitable to invest in ESG? They didn't care inherently about the ESG preferences. They just thought, if I invest in ESG, I will make a buck. Okay. So now we are almost only running experiments. So what did we do? Well, first of all, the problem here is that, if you ask people, do you like green investments or do you think it's the right thing to do? Of course, what will they answer? They will say, sure, it's the thing we have to do, right? It's the right thing. It's like if I ask you, do you think we should support the poor? You say, yes, we have to support the poor. If I ask you, but then we have to tax you more, You will say, I don't know, right? So that's the problem with self-reporting and social desirability. If we ask people, do you like green stuff? They will for sure say, yes, investing in green is a good thing. Okay, so we will overcome this with the little experiment. And the next thing we did was we wanted to disentangle whether people have environmental preferences or social preferences. So it makes a difference whether you want to reduce carbon offsetting or whether you want to reduce carbon emissions, right? Or whether you don't want to have the people drown in little islands somewhere in the Pacific because the sea level is rising, okay? That's a different thing. So what did we do? Well, we collected data with the rocket platforms, Green Rocket and Home Rocket. 399 investors participated in the experiment. We got ethical approval for the study, and we also pre-registered all of our analyses we did later on. So that's pretty standard nowadays. So what did we do? Well, here you have one of these platforms. So this is Green Rocket, and you can see, you cannot read it, but I will tell you, it looks already green, right? So what they do is like they come up with real green innovation and startups and so on. And then, if you look at the descriptions, you see there's this reusable cups, but the whole idea about Green Rocket is that they do something green, right? And you should finance it as a crowd investor. Okay, on the other hand, they have the Home Rocket platform, and that one is not about green at all. So the Home Rocket platform actually only gives you investments in real estate, but it's not that the real estate has been transformed in an ecological manner or something like this. So it's a purely investment type of investment, right? Also, if you look at the description, right, they don't say like we use environmental standards in order to do it. So it was a real investment case. So how can we find out about the true preferences, right? We didn't want to ask people, do you like the green stuff? Then they would have said, yeah, for sure, I like it. So we asked them the following. Would you rather have a 25 euro voucher for the Home Rocket platform, which means there's no green component at all, right? I mean, it only gives you an additional return, and it's quite high, right? I mean, if you wanted to make a 100 euro investment, now you only have to invest 75 euros. Getting 25 is almost a 33% expected return, right? So that's not too bad. Or would you rather have us to donate money? And we offered to donate money for Greenpeace, carbon offsetting, or the International Red Cross. And now you can think about it yourself. What would you do, right? I mean, if you get the choice, would you take the 25 euro voucher? Or would you have us donate the money somewhere else? So if you're a really green and social person, right, you would accept a very low number in terms of donations to carbon offsetting, right? So if you're a really green person, a little donation would be fine for you. But if you're not so green and you think like, the return is more important to me, you need a very high donation to offset the 25 euro voucher. So this is actually how we can elicit whether people have green preferences or not. Okay, so we gave them the choice and we told them, would you rather have the 25 euro voucher or 1 euro donation or 25 euro voucher or 2 euro donation? And in order to make it not that boring, right, they didn't have to go through all of the numbers. We just asked them, at which line would you actually switch? When would you forego the 25 euro voucher, the real investment return, for the donation in a good course? So we know where the cutoff is, right? So that's very interesting. We did Greenpeace and we did the CO2 reductions because not everyone likes Greenpeace, right? So for that reason, CO2 reduction was more neutral and the social purpose was the Red Cross. Okay, so we have this measure, willingness to accept the green donation, and we have the other measure, willingness to accept the Red Cross. And as I just said, the lower the willingness to accept this donation, the higher must be your environmental preferences. So we sent out an email to more than 4,000 investors in 2021. We only got people who have invested before, so we wanted to have the real investors on the platform, not only people hanging around there like me as an academic, right? And then we got 399 people actually participating, which is a participation rate of 8%. So were these the more altruistic people and so on, were they different from all the other people? No, actually not. We could check like the people who participated were the same gender, same age, and so on. They also came for the green platform in the same percentage as all the other guys. So they were not special in a sense. Okay, so here's the first result. So a little bit of statistics. So this is a density function. So it tells you, a cumulative density function actually. So what it tells you is like if you start here on the left-hand side, you see here, these are the donations, €1 to up to €50 that would be acceptable to investors. And you see 13% of the investors give up a higher return, that is the voucher, for any kind of impact, right? They would say, if I only get €1 donated to Greenpeace, that's fine for me, right? I don't want to have the €25 voucher. And then on the other hand, you have like these 25%, there you have to give a very high return in order that they, very high impact in order that they give up the return. So it means like they would never give up the €25 voucher for any kind of impact we give them, right? I mean, it must be more than €50. But what is interesting is like in between, and that might be interesting for the startups, right? I mean, it really matters of how big the impact is to the investor, right? I mean, it's not that they're saying like, there's greenwashing. If there's a little bit of green on it, that's fine for me. Like, let's put a little stamp on it, and I accept that as an investment, right? They want to see how big the impact is that you're making with your investment. Okay, that holds for the green stuff, and it holds for the social stuff as well. Okay, a little bit more of statistics. You don't have to understand the statistics. I will walk you through them. So what does it mean? So what we want to explain is the share of investments people actually made in their portfolio. So we know their portfolio composition in terms of green investments, right? Can we explain it with their green preferences? Well, actually we can, right? So there's a statistical effect throughout, and it tells you that, if you had a true preference for green, so if you were willing to accept a lower donation to a green cause, right, then you in fact had previously already a higher share of your investments in green assets. So your intrinsic green preferences did play a role. The next thing is, like, we asked them, do you think that green assets are more profitable, as profitable, or less profitable than other assets? Well, as a finance professor, I can tell you in expectation they shouldn't be more profitable, but at least not in the long run. But what you can see is that those people who believed that they are more profitable had a more than 20% higher share of green investments in their portfolio. So the belief that they are more profitable actually made people invest in that. Okay, so it doesn't only hold for those people in general in our sample, it also holds for those people who never joined a green platform. So meaning that they didn't go for Green Rocket, they might have come for the real estate platform. So even those more conservative investors, as you want to say, like even for them, both factors played a role. The belief that it's more profitable and the intrinsic environmental preferences. Again, like as a poor university, we could only spend €50 as a max, right? So if we had different funding, we could have done differently. But what you see is like, those people who said like, if you donate more than €50, I might change my mind and I would go for the environmental course. But you can see that those guys who said like, you need to make a really big donation for environmental course, then I would actually change my portfolio composition. Well, they actually had also a 43% lower share of green assets in their portfolio, so which is consistent. Finally, for the red cross, you see that the social impact didn't play a role for them at all, like not in their investment decisions. So it didn't change their share of green investments. And I will tell you what it means. So the first thing, what it means is like, we have actually very equal elasticity, meaning that you have a share of green projects of 1% more in your portfolio if you would be willing to forego more or less a €1 in smaller donations in green stuff, right? So meaning that if I go from €50 donations for Greenpeace down to 1 for one investor, it would mean that they have a 50% higher share of ESG in their portfolio. What else? Well, 20% higher share of green assets if you believe that they are more profitable. I told you that before. I also told you that the more conventional investors, you see the same effect, even though the effect size is a bit smaller. But finally, we also observed that investors behave as if their green investments do not have a social impact. So what does it mean? Well, it means like they invest as if investing in green doesn't affect the people living on the islands that potentially drown because of climate change. So that doesn't matter to them, right? It matters to them that CO2 is reduced. So that's important to them, apparently. So we also asked them, like we gave them a simple survey question just to make sure that our experiment has worked. And actually, here's what you see. So on the right-hand side, you see what is very important to them, fairly important to them, not important to them. You see, again, a higher interest rate in terms of the return is very important for them. Environmental impact is very important to them, right? They receive previous funding as a signal is very important to them. But what you can see is like the measures that venture capitalists would actually use, are the founders any good? Did they already have a marketable product? For crowd investors, it didn't really matter. Like a market already entered, didn't matter. Likeable of founders, like if the founders are not so nice, it didn't really matter to them. Then we asked them, why do you do crowdfunding? And that was very interesting to us because it showed the most important thing for them was, you can actually choose your own investment. So people said, I don't want to buy a big stock of a big index because you buy a big bunch of projects within this firm. What they wanted to do is they wanted to invest in a specific project. So they wanted to choose which project it is. So they're very self-determined, right? On the other hand, again, like venture capitalists, they would probably, that wouldn't be the most important thing for them. And then what is interesting is like there's a lot of literature saying like, why do you do crowdfunding, right? I mean, they say, well, this is because there's this community spirit, right? There are all these people in the crowd, they work together, and it's so nice, right? And then you can say, if you ask people like that others are doing crowdfunding too, like their family and friends, and you can actually observe that they do it too, didn't really matter to them. So that was not the most important point. So now the interesting question comes. How can you actually, now that we know that people have environmental preferences, how can you make them invest? How can you attract their attention, right? So what we did was, again, another experiment. We manipulated the newsletter on a different platform now, which was BetterVest. So we had 10 newsletters, and we sent them out to all of the investors. So BetterVest came up with their initial newsletter. We sent it out. We observed more than 50,000 clicks and investment decisions. And we wanted to know, did they click on the newsletter to get more information? And did they actually make the investment later on based on the newsletter? We gave them 3 treatments. So one was the original basement. So it was like what BetterVest would have written. The other one was we reframed it. We took out all the return information. We only put in the environmental information and said, like, it's a very green project, blah, blah, blah. And then in the other treatment, we said, like, we took out everything that was related to ecological stuff. We only took in the return information. You make so and so much return on this investment. Here's how it looks like. This was the first one, and it's probably too small for you, but here we're stating the UN development goals, the CO2 reduction savings, and so on. And here we are saying, like, there's a return, and you get an advanced interest, and then we change the text so it would be purely ecological or purely return-oriented. Think about it. Would you think that makes a difference for investors? Well, it does. It makes a difference. So if you have the ecological treatment, this is a positive and significant effect. So it meant that if you had the ecological information, people clicked more often. But did they invest more often? No, they didn't invest more often. What we also found is, like, first of all, with the ecological treatment, you saw 13% more clicks, so people got more information, didn't change their investment behavior. But older people, so above median people, so not judging anyone, right? Just saying in our sample above the median, you could see that actually investors click much more often, approximately 37% of the time than the control group, once they got the return information, right? Older people are more in for the return. And interestingly for us as well, maybe I'm too prejudiced, but women also clicked more for the return information. So they found it more interesting if we gave them a newsletter about the return information. Okay, so now if that didn't work, right, I mean, they got more attention, what does work? So then we run another experiment with the robo-advisor in Germany, and that actually worked quite well. So what did we do? It's actually just still running, but this is the first time we're presenting this. So we got almost 1,000 customers during the onboarding process, and we changed the onboarding process a bit. So what did we do? We gave them a default, which was green investments, and we gave them another default, which was non-green investments. And as you might think, right, as an economist, you might think, well, if people like chocolate ice cream more than vanilla, they will like it today and they will like it tomorrow. It doesn't matter to them, right? I mean, if you tick the box chocolate and they like vanilla, they will still go for vanilla, right? I mean, defaults shouldn't matter for them. But it mattered a big time, right? So here's how it looked like, right? I mean, it says, like, how would you like to invest? The default could be classic or ESG in our treatments, right? The one or the other. and we could click foreign currencies, yes or no, emerging markets, yes or no, and then here are the results. And as you can see, it mattered big time. So if you can see, classic means the default option was classic, 20% invested in ESG. If the default option was already ESG, sustainability, then almost 50% invested in ESG, meaning that that's a 150% difference in percentage-wise, right, between the two. So the default make a big difference whether people are investing in ESG or not. Same holds for foreign currency and emerging markets. You can see with both slightly above and below 60% invested in foreign currencies or emerging markets if it was not the default. But if you made it the default, then you can see almost 100 or almost 90% invested in these stocks. So defaults matter a lot. Okay, so there's no keynote without talking about generative AI, right? But that's the last thing I'm going to do. So the question we raised here was, can GPT-4 provide financial advice? What did we do? Well, we know that retail investors often make costly mistakes. Financial advisors, oftentimes, they don't want to correct them because they have their own products, right? They want to support their own products for that reason. They give you some advice that might not be very helpful. And modern portfolio theory suggests that if you're very uninformed, what should you do? Just buy a big market portfolio as broad as you can. And if you're not able to rebalance, just try to hold it, right? And that's it. So, but GPT-4 and Gen AI in general is capable to use a lot of public information, right? So if someone should be able to give informed advice and potentially also less biased, it should be generative AI. Okay, so what did we do? We know there are all the regulatory guidelines, right? You have to take the individual circumstances of the client into account. So what we did was we generated 48 different accounts on GPT or profiles, as you want to say, of different individual investors. So we changed their risk capacity, investment horizon, 5 or 40 years, risk tolerance, high or low, ESG preferences, yes or no, and so on. And then we entered this text. I'm a 40-year-old and live in the United States. I'm investing for retirement over, for instance, 40-year horizon or 5-year horizon. And I have a high risk tolerance, environmental aspects are not important to me or are important to me, and so on. So we did all the variations, and we want to say whether it changed the portfolio composition. So okay, we did this, and then again, you might not see it, but what it tells you is like, GPT gave you very precise financial advice. So it told you the portfolio composition, how much percentage points you should invest in which asset, and it also gave you an explanation why you should do it. That's very good because actually this will actually help to people accept the advice they got. So here's the portfolio composition for GPT, and what it tells you is that first of all, large percentage of stocks, which is good, right? A large equity share depending on your investment horizon. So if the investment horizon was longer, you got a larger equity share. There's a lot of domestic assets GPT-4 would recommend. And then we actually benchmarked it. So we said, like, what would a professional portfolio advisor in the US do that has around 50 billion under management? We generated the same profiles with the US robo-advisor and entered it. And we saw actually it was quite similar to what GPT did and what the robo-advisor did. No worries, the robo-advisor didn't use AI, so we checked that before. So what did we find? Well, most generally, the assets that have been recommended had the same geographical regions in GPT and the robo-advisor. We also found that they had more or less the same assets. Interestingly, GPT had a considerable home bias. So if you entered the US as a nation, then you would get a lot of US assets. If you entered Germany, the same would have happened. You would have a home bias for Germany in your assets with GPT. And it was much bigger than the robo-advisor. Like GPT recommended 80% of the total assets to be domestic. The robo-advisor recommended 47%, and the MSCI World would have been 60%. So in any way, GPT was a bit home biased, I would say. So what else? Portfolio suggestions were very sensitive to risk tolerance, but less sensitive to risk and investment horizon. And so what else we did was, that apparently doesn't appear right. But what it actually shows you is, or should show you, is that that we also calculate the returns and the risk and the Sharpe ratios. So what it means is that actually what we find is that the risk GPT is taking is a bit higher than the benchmark. So GPT is a bit risk-loving, but for that reason, it also slightly outperforms the benchmark. Okay. So yeah, for the highest risk profile, it had also an outperformance. And if you would have invested $100 in 2016, then actually you can see on the left hand, this is GPT performance for 4 profiles we generated. This is the robo-advisor. So the performance was quite similar. Like the macroeconomic shocks in the portfolios were absorbed quite similarly for both of them. The final thing we did, and that's the final thing of my talk, well, the GPT outperformed in terms of, on a risk-adjusted basis. Well, then you can actually see, so this is a factor model, so it has the 6 most common factors in here, so in alpha, whether there's outperformance or not. You can actually see, well, the outperformance is negative for GPT and for the big robo-advisor, while truth being told, the outperformance given that you consider all the 6 risk factors, right? I mean, the robo-advisor and GPT cannot outperform above and beyond the risk factors. So on a risk-adjusted basis, GPT is as good as a good financial robo-advisor in the US, and it has earned a negative alpha, but the robo-advisor didn't earn a positive alpha either. Okay. So what do we do out of this? So here comes my conclusion. First of all, on the state level, I would say not so much new, right? I mean, what matters is economic development, institutions, infrastructure. Who am I telling that, right? Estonia is doing pretty well in all of these things. Not surprisingly, they have a lot of fintechs on a per capita basis. But on the other hand, what I found interesting in the research is actually that fintechs are actually good on average for the financial sector, meaning good for risk and good for their performance. Second thing, what matters on the firm level? Well, founders and firm resources matter. Also, not that surprising, right? But on the other hand, what is interesting is that it takes the right mix, right? I mean, it's not that you should only have financial people. You should have STEM people, financial people, so you survive, you get funding, and you're innovative. And then invent something new, right? I mean, if you come up with the financial stuff that banks have doing for ages and you're trying to do a little bit new, right? I mean, that won't really help you to survive. What is better if you come up with any form of leap innovation? I mean, it's not easy to do, but obviously that would be the greatest thing you can do. Final thing, so investors apparently don't fully understand ESG, right? I mean, they believe it should outperform. Well, it shouldn't in the long run, it could in the short run. Nowadays, potentially almost everything is ESG, right? And then we find that generative AI can be a very cost-efficient solution for financial advice. And even for traditional financial institutions, I mean, they can simply put it in the background, right, and still give financial advice. We found it worked pretty well, right, on a general basis. And it will probably work even better in the future. And if you want to do any experiments, please let me know. And if you're still looking for a Christmas present, I have a couple of suggestions for you. Thanks very much.